In July 2023, your bank probably sent you a letter. It arrived in the same stack as credit card offers, mortgage promotions, and grocery coupons. You most likely glanced at the envelope, saw the bank logo, and tossed it aside with the rest of the boring paperwork. But that letter quietly announced the most significant shift in American banking in the last 50 years. Everything about how your money moves through the financial system changed almost overnight. Yet the notice was written as if it were just another routine service update. Think about the kind of mail you usually get from your bank: account statements, privacy policy updates, changes to fee schedules, promotional offers. We've all been trained to skim or ignore those letters because almost none of them ever change anything that feels important in our day-to-day life. This time was different. This time your bank was informing you, without calling attention to it, that your account was being moved off traditional private banking rails and directly onto Federal Reserve infrastructure. Let's slow down and walk through what actually happened. On July 20th, 2023, the Federal Reserve officially launched a new system called the FedNow service. This wasn't just another payment app or a mobile banking feature. FedNow was introduced as a real-time payment service, but in practice it began replacing the automated clearinghouse, ACH system, that had been used for more than half a century to move money between banks in the United States. 4 days later, on July 24th, customers of Webster Bank received a letter announcing exciting updates to their accounts. This is where the messaging became extremely clever. The Webster Bank letter spent most of its space reassuring customers about what would not change. It said that your account number would stay the same. Your direct deposits would continue as usual. Your debit card would still work. You would keep access to 40,000 ATMs through something called the MoneyPass network. On the surface, it sounded like a normal service enhancement. Nothing scary, nothing controversial, just better access and smoother payments. Buried in the fine print of the disclosure, however, was the real story. The letter explained, using dense legalistic language, that your account would no longer settle payments through private banking networks. Instead, every transaction tied to that account would now be processed and settled through Federal Reserve master accounts via FedNow. In practical terms, that means every dollar you spend, every payment you receive, and every transfer you initiate now flows across rails that are directly operated by the Federal Reserve. The federal government is no longer just overseeing the banking system from a distance. It sits on the transaction highway itself and can see traffic in real time. We've seen a similar pattern before in American financial history. In August 1971, President Richard Nixon went on television and announced that the United States would temporarily suspend the convertibility of dollars into gold. He told Americans that nothing in their daily lives needed to change. They would still receive their paychecks. Their savings accounts would still function. Stores would still accept their money. Daily life would go on. But under the surface, everything had changed. The United States had transitioned from sound money backed by gold to a pure fiat currency regime, where the value of money was now entirely dependent on government policy and central bank decisions. Today we are watching a similar playbook unfold, this time centered on the architecture of banking and payment systems, rather than the gold standard. A major shift in the financial regime is again being presented as a harmless service improvement. The difference now is that banks are not asking for your permission in any meaningful way. They are not saying, "Would you like to participate in this new system?" They are simply informing you after the fact that your account is now moving on to Federal Reserve payment rails instead of the traditional private banking infrastructure that existed for decades. Ask yourself, when was the last time you carefully read one of those long banking disclosure letters front to back? Most Americans never do. Banks know this. Regulators know this. That is precisely why this particular transformation was routed through disclosure documents and routine update notices. It allowed banks to shift accounts onto FedNow infrastructure without sparking public discussion, media scrutiny, or political debate. The timing tells you everything you need to know. FedNow was not built in a rush as a response to a sudden crisis. The Federal Reserve announced its plans to develop FedNow in 2019. Over the next 4 years, it invested in building the infrastructure, testing the technology, coordinating with large processors, and preparing member banks for the transition. This was not an improvised fix. It was a long-term strategic project. The only real question was how to move millions of American bank accounts onto Federal Reserve rails without attracting attention or resistance. Those Webster Bank customers who actually read the July letter discovered some telling details. The bank spent multiple paragraphs touting benefits like instant transfers, real-time availability, and 24/7 to 365 payment processing. These features sound impressive until you remember that services like Venmo, Cash App, Zelle, and other private payment platforms had already been providing instant or near-instant transfers for years. Speed was not the true innovation. The real change was architectural. Your bank account quietly shifted from being part of an independent private banking network to being a node in a payment system directly integrated with Federal Reserve infrastructure. When you pay your electric bill or move money to your savings account, the settlement no longer happens primarily between private banks. It now runs through the Federal Reserve's master account system via FedNow. That has serious implications for financial privacy. Under the old system, before FedNow, the government generally needed subpoenas, court orders, or national security letters to access detailed banking information about you. Banks were the legal custodians of your transaction data. They could, at least in theory, challenge overly broad requests, require due process, or maintain some layer of separation between you and the state. With FedNow, the Federal Reserve becomes the infrastructure layer for real-time payments. It no longer needs to request access to the data it already processes. Every payment flows through a system it operates. The boundary between regulatory oversight and direct operational control becomes thin or even meaningless. But the most alarming piece of this puzzle is not simply that FedNow exists. It is what FedNow is designed to enable. That seemingly harmless letter you received in July 2023 did more than move your account onto new payment rails. According to the terms and conditions embedded in those disclosures, you also agreed in advance to enhanced digital services and future innovations tied to Federal Reserve payment capabilities. Put in plain language, you pre-approved the next step. When the Federal Reserve ultimately rolls out a central bank digital currency, a CBDC, your existing FedNow connected account, is positioned to convert seamlessly into a CBDC account. The migration path has already been engineered. By the time most people wake up to what happened, they will discover that the legal and technical groundwork was quietly laid years earlier, largely through routine letters they never read. The foundation has been poured, the path has been mapped. And the vast majority of Americans still believe their money operates on the same old banking infrastructure it always has. But it doesn't. Their accounts now sit on the payment system that can become, with a few policy changes and software updates, the backbone of a fully centralized digital currency regime. Your bank did not simply upgrade your account in July 2023. It repositioned your account inside a government-operated payment grid. To understand why that matters for your freedom, we need to look more closely at how payments used to work and what exactly FedNow changed. Before FedNow, if you paid your mortgage, sent money to a friend, or moved funds to your kids at college, the transaction typically traveled through the Automated Clearinghouse, ACH system. ACH processed transactions in batches rather than in real time. Payments might be queued overnight, over weekends, or through holidays before they fully settled. That delay seemed like inefficiency, but it functioned as a kind of buffer and protection. Payments moved primarily between private banks that maintained their own reserves and relationships. If you sent money from Chase to Bank of America, those institutions settled between themselves through private networks and existing arrangements. The Federal Reserve played an oversight role, but it was not directly executing every individual retail transaction in real time. Banks retained some independence in how they handled payment flows and customer relationships. FedNow changed that architecture at a fundamental level. With FedNow, payments are designed to operate in real time, 24 hours a day, 365 days a year, using Federal Reserve-operated rails. Every transaction settles instantly and, in most cases, irrevocably through master accounts at the Fed. When you swipe your card for groceries, pay rent, or transfer money between accounts, the Federal Reserve's infrastructure now handles that settlement process. It sees the transaction as it happens, not as historical data it later reviews. In this environment, the government no longer has to go through banks to gain visibility into individual transactions. It is wired into the system at the deepest level. The official story is that FedNow exists to modernize payments, improve speed, and bring the U.S. in line with other countries that already have real-time payment systems. But look at the feature set and the timing, and another purpose emerges. FedNow's capabilities line up almost perfectly with the requirements for a central bank digital currency: real-time settlement, direct processing by the central bank, centralized control through master accounts, and irrevocable payments that can be tightly monitored and controlled. The Federal Reserve announced FedNow in 2019 and took 4 years to bring it online. That timeline was not just about coding a payment system. It was about building out the infrastructure needed so that when a CBDC is eventually introduced, the plumbing is already in place across the banking system. In other words, your account migration in 2023 was not an isolated upgrade. It was phase one of a larger transition. The adoption strategy was subtle but powerful. When FedNow launched, only a limited number of early adopter institutions went live, around a few dozen banks and service providers. But the system was built to spread quickly via correspondent banking and payment processors. Take Webster Bank as an example. It relies on Fiserv for payment processing. Fiserv itself became a FedNow early adopter and integration partner. Through Fiserv's MoneyPass network, more than 2,000 financial institutions gained indirect access to FedNow's rails. When a large processor plugs in at the top, thousands of local banks are effectively pulled along. What appears on paper as many independent decisions by separate banks is, in reality, a coordinated infrastructure shift driven from the center. That is why the Webster letter talks so much about ATM access and the MoneyPass network. Access to 40,000 ATMs sounds like a perk for you as a customer, but MoneyPass also functions as a connectivity bridge into Federal Reserve payment infrastructure. While you are focused on the convenience, your bank is reconfiguring how and where your transactions are processed. Another crucial feature of FedNow is the irrevocability of payments. Once a FedNow transaction is completed, it generally cannot be pulled back. That is a sharp departure from older systems, where ACH payments could sometimes be reversed and credit card transactions could be disputed or charged back. Why design a system where reversals and chargebacks are extremely limited? From a control perspective, irrevocable transactions give whoever operates the system here, the Federal Reserve, and by extension, the federal government unmatched leverage. Funds can be frozen, seized, or redirected at the infrastructure level. Once a move is executed, there is no easy mechanism for customers or even banks to undo it. Combine that with real-time processing and centralized visibility, and you have the skeleton of a powerful control apparatus. FedNow also enables something else: the ability for the Federal Reserve to push money directly into accounts that sit on its rails. Under the traditional system, the Fed mostly interacted with banks, not individual citizens. With FedNow, the central bank can, in practice, credit or debit balances in accounts that are tied directly into its system, bypassing some of the traditional intermediation role of private banks. That is exactly what a central bank digital currency would require. A CBDC is not just a digital version of cash. It is programmable money. Every unit can carry code, rules, or conditions. Under a CBDC regime, authorities could program how, where, and when your money can be spent. The COVID-19 era gave us a preview of this logic. Stimulus payments with usage windows, emergency assistance restricted to certain categories of expenses, and funds that had to be spent within specific time frames. Those ideas, which were implemented through policy and bureaucracy, become drastically easier to enforce when the money itself is programmable at the central bank level. Imagine a world where your digital dollars come with built-in restrictions. Money that expires if not spent quickly enough. Transactions that can only be made for government-approved products or within certain distances of your registered address. Donations to specific organizations automatically flagged, blocked, or penalized. Purchases of items deemed unhealthy, unsafe, or politically sensitive quietly refused at the point of sale. Under a CBDC built on FedNow rails, this kind of granular control is not science fiction. It is a design option. Why did banks go along with this transformation? In public, the move is framed as voluntary modernization. In practice, the Federal Reserve sets the rules of the game. If a bank wants continued access to core Federal Reserve services, the very lifeline of its operations, it has little real choice but to align with the infrastructure roadmap. Refusing FedNow integration would eventually mean standing outside the real-time payments grid that the rest of the industry is moving onto. That is not a viable option for most institutions. As FedNow adoption spreads through 2024 and 2025, more banks large and small are either directly connecting to the system or indirectly connecting through processors and correspondent relationships. Step by step, the old architecture is being replaced. The exit ramps are slowly disappearing. Before this transition, you could preserve some financial autonomy by using cash, choosing community banks, or relying on private payment systems that were less tightly integrated with federal infrastructure. Over time, as CBDC pilots are launched and digital currency becomes recommended, then preferred, and eventually required for certain transactions, those alternatives will shrink. Cash will be portrayed as inconvenient, unsanitary, risky, or associated with crime and tax evasion. Businesses will be nudged, then pressured, then forced to go cashless. Banks will add fees or hurdles around depositing and withdrawing physical currency. Whether or not cash remains technically legal, it will become increasingly impractical to use. All of this can happen without a single dramatic announcement. No midnight law banning cash. No loud declaration that private banking autonomy is over. Just a series of upgrades, policy tweaks, pilot programs, incentives, and quiet letters mailed in plain envelopes that most people never open. By the time a full-scale CBDC is launched, likely framed as a logical extension of the FedNow improvements, you may find that your accounts are already fully wired in. The infrastructure will be complete, the terms already accepted, the alternatives marginalized. Americans did not actively vote on this transformation. Congress did not hold a national referendum on FedNow or CBDC. Yet the architecture of a new monetary regime is being built, piece by piece, through regulatory decisions, central bank initiatives, and private sector partnerships. The letter your bank mailed you in July 2023 was not just another piece of paperwork. It was the notification that your money had entered a new system, one where the boundary between your private finances and government infrastructure is thinner than ever before, and where the path to central bank digital currency has already been quietly paved. To see the larger pattern, it helps to look at the timeline. In 2019, the Federal Reserve announced FedNow. From 2019 to mid-2023, the system was designed, tested, and integrated with early adopter banks. In July 2023, it quietly went live, and the first wave of customers, including Webster's, had their accounts shifted onto the new rails through routine disclosure letters. Through 2024 and 2025, more institutions connect, and FedNow becomes the default plumbing of the U.S. banking system. By the time most people realize their money no longer moves on the old architecture, the migration will already be complete. Once that infrastructure is widespread, it becomes easy to layer a central bank digital currency on top of it. Pilot CBDC programs can start with narrow groups, federal employees, contractors, or benefit recipients, framed as experiments in efficiency and financial inclusion. Then come broader rollouts, marketed as a natural extension of the speed and convenience people already experienced through FedNow. If this trajectory continues, by the late 2020s, a CBDC could sit at the center of everyday economic life, while cash and independent digital payment options are steadily pushed to the margins. At that point, choosing to live outside the system will be difficult in practice, even if it remains technically legal. Under such a regime, every transaction becomes a data point and a control point. Your spending can be profiled automatically. Donations, travel, and purchases that fall outside approved norms can be flagged or restricted. The most unsettling part is how little open debate has taken place. Americans did not cast a clear vote to move their accounts onto FedNow rails or to pre-authorize a future CBDC. The core technical and legal steps are being taken first. The political conversation, if it comes at all, will arrive after the system is already embedded in daily life. All of this began for many people with a letter they never read in the summer of 2023. That envelope looked like ordinary bank paperwork. In reality, it announced that your account was being plugged into a new kind of financial infrastructure, one that brings your personal money flows closer than ever to direct government oversight. FedNow did not simply make your payments faster, it repositioned your bank account as a terminal on a network operated by the central bank, laying quiet groundwork for a future in which every dollar you earn, spend, or save can be observed and, if policymakers choose, programmed at the infrastructure level.